You need to decide for yourself whether gold constitutes liquidity for you. I learned myself I can sell gold if something is more attractive. I think today's prices are fair. Not great, fair. Warren Buffett, no fan of gold, and not speaking about gold mines, said that what he learned from Charlie Munger, that it was better to buy a great something at a fair price than a fair something at a great price. Gold is a bet, really, on the deteriorating purchasing power of the US dollar. Confidence is hard on gold. Higher interest rates in the near term are hard on gold until the market comes to realize that the reason for the higher interest rates is fear of inflation, which is good for gold. When people tell me the so-called truism that higher interest rates are bad for gold, I say only for a period. I consider the gold mining industry, given what I think happens to the purchasing power of the US dollar over the next 10 years, to be a great opportunity. 10% that real interest rates are sharply negative. And if you juxtapose, to make the math simple, deterioration in the purchasing power of the US dollar, the 10-year treasury isn't paying you 5, it's costing you 5. And it's that circumstance in the decade of the 1970s that propelled the gold price.
Are you considering any catalysts to this type of change? Or are you just watching and waiting for
Math.
that?
The catalyst is math. If you assume that there's, I don't know how many there are, 400 million players in the U.S., they're not going to turn on a dime. So is there going to be some overnight reaction? Tradable? Nah. It's just going to be simple math. The voter is going to be overwhelmed, the voter and the investor, going to be overwhelmed by reality over time.
All right, Rick, where do you see the greatest investment opportunities right now in all of this chaos and change and volatility?
For most people, gold. I think you need to do a few things that most people don't want to do. The first is that despite the fact you lose money doing it, you have to maintain liquidity. And that's really expensive. My savings, and they're substantial, are costing me probably 4% in purchasing power annually. I consider that negative yield to be an option premium on having the liquidity available to take advantage of a liquidity squeeze. While I'm not suggesting that a liquidity squeeze is necessarily imminent, I think it's inevitable. And I remember back to 1987, also 2008. In 1987, I didn't have liquidity, so I couldn't take advantage of the circumstance. 2008, I had plenty. And the consequence of that is that 2009 was the best investment year of my career.
The market keeps celebrating resilience while purchasing power quietly dies in cash accounts every single year. As Rick Rule points out here, losing 4% annually to inflation may actually be the price of survival when liquidity finally disappears. Wall Street keeps telling savers to stay fully invested because idle cash hurts returns. Yet every major crisis rewarded those holding dry powder first. The uncomfortable reality is that liquidity becomes priceless only after it vanishes. Next, Rick Rule exposes why institutional cash positioning already signals fear beneath the market's confidence.
So you have to have liquidity despite the fact it's expensive. And you have to have gold. You need to decide for yourself whether gold constitutes liquidity for you. I learned myself I can sell gold if something is more attractive, but I know some gold bugs who can't bring themselves to sell gold in any circumstance. So for them, they have to regard it as an asset class that isn't liquid. But 1,000 years or more of recorded history have told us that gold protects us from the deteriorating purchasing power of fiat instruments, particularly when interest rates are negative. I read a J.P. Morgan Chase statistic, I believe it was, that precious metals and precious metals related equity constitutes 0.5% of the total savings and investment assets in the United States. They suggest that that's down from a 4-decade mean of 2%. I'm not saying we have to have mean reversion, but I'm not saying that ultimately we won't overshoot the mean either. What I'm trying to say is that it's a very, very, very underowned asset class relative to what I see as the risks inherent in not owning it. In direct answer to your question, not for me, because I've been saving in gold for 25 years, but for most people, the most efficacious addition to their savings that they could make would be gold. And by the way, they should increase all of their liquidity because I'm afraid, not certain, but afraid it's going to come in handy. For people who are investors as opposed merely to savers, they should consider the highest quality gold equities. They have names: Franco-Nevada, Wheaton Precious, and Agnico Eagle.
JP Morgan's own allocation data shows precious metals sit near historic lows in American portfolios, despite relentless inflation pressure. According to Rick Rule, gold ownership has collapsed to roughly 1/4 of its long-term average allocation, even while debt, deficits, and monetary expansion accelerate simultaneously. Institutions publicly praise diversification, while pension funds remain dangerously concentrated in financial assets dependent on low rate stability. For ordinary savers, that imbalance matters because even a small capital rotation into metals could violently reset pricing. Next, Rick Rule reveals why the most under-owned assets often become the fastest moving trades during systemic stress.
For people who are willing to do the work, endure volatility, and embrace real risk, they need to speculate in the rest of the gold mining sector. For people who aren't willing to do the work, they should avoid that sector like the plague. There are wide variances in quality and wide variances in risk. And people who aren't tolerant of volatility and aren't willing to do the work to obviate to the extent they can single company risk would be well advised to skip that portion of this interview. Confidence, such as it exists, is hard on gold. Gold is a bet, really, on the deteriorating purchasing power of the US dollar. Confidence is hard on gold. Higher interest rates in the near term are hard on gold until the market comes to realize that the reason for the higher interest rates is fear of inflation, which is good for gold. When people tell me the so-called truism that higher interest rates are bad for gold, I say only for a period. During the period of the decade of the 1970s, the 10-year rate rose from 3.6, 3.7 to 18. And the gold price ran 26-fold. So when people tell me that the gold price can't do well during a period of rising interest rates, I wonder if I actually lived through the decade of the 70s, and I can assure you that I did. In the near term, which is increasingly the way people think, that's become a truism, perhaps a factoid, which is to say it's believed to be true because it has been observed in the past.
Markets keep repeating that rising rates kill gold, yet history's biggest gold bull market happened during exploding treasury yields. What Rick Rule is highlighting here is the difference between nominal rates and real purchasing power destruction, something mainstream financial television rarely explains honestly. In the 1970s, rates surged because inflation panic overwhelmed confidence in fiat currency, and gold responded by multiplying higher anyway. Investors focusing only on Fed headlines may completely miss the deeper inflation psychology driving long-term capital flows. Next, Rick Rule unravels why the Federal Reserve benefits when investors confuse higher rates with genuine monetary strength.
But if you look at the underlying reasons for both phenomenon, then you understand that circumstance, which is to say rising gold prices and real nominal interest rates, aren't mutually exclusive.
A bit of a deflationary episode in oil and oil-related equities, but that is not the end of the story. That's only the beginning of the next chapter.
And if you're smart enough to trade it, God bless you. If you don't own oil equities, if the war is prolonged, there are higher oil prices. If the war ends, there are lower oil prices and then higher oil prices.
Okay.
People have told me, including people very close to me, Rick, you're so far up on your oil equities, you need to sell them. And I thought about it, and then I said, why? If I sell them, I pay capital gains tax. I shield myself from a downside which I feel is temporary, and I have to buy back in to participate in an upside that I think of as inevitable. Now, how will I feel 6 months from now if Exxon falls from 180 to 120? probably feel pretty good because I bought it for 85 or 90. But my circumstance is different. If you own oil equities, feel free, if you think you're smarter than the rest of the world, to trade them.
Right.
If you don't, own them.
It's interesting when you were describing that. I feel very similar about precious metals miners to the very setup you just described. I do think any fall that they've had and may continue to have is temporary compared to what's coming.
Energy markets are reacting to headlines daily, but the larger capital cycle underneath them has barely started moving yet. Rick Rule's argument suggests temporary oil weakness may simply be a reset before another inflationary surge tied to supply constraints and geopolitical instability. The important signal is that insiders holding long-term commodity positions are not rushing for exits despite violent short-term volatility. That patience matters because retail investors usually sell cyclicals right before the structural move resumes upward. Next, Rick Rule reveals why commodity investors focusing on short-term corrections may miss the real inflation supercycle entirely.
I would agree with that. Warren Buffett, no fan of gold, and not speaking about gold mines, said that what he learned from Charlie Munger was that it was better to buy a great something at a fair price than a fair something at a great price. I consider the gold mining industry, given what I think happens to the purchasing power of the US dollar over the next 10 years, to be a great opportunity. I think today's prices are fair. Not great, fair. But I like the idea that I'm going to buy a great something for a fair price. Specifically, if the purchasing power of the US dollar declines, as I believe, by 75% over 10 years, I think that gold will maintain its nominal value, which means the gold price will do very well. If the gold price does very well, gold stocks relative to the gold price are already at attractive levels. Attractive levels relative to other industries? Maybe not. But attractive relative to the price that the fact that the nominal price of gold will do, I think, very well.
Hard asset strategies have been starved of capital for a very long time. You've been talking about this. When tech re-rates towards neutral in a higher yield environment, this rotation would be measured in trillions of dollars. A move of 43% concentration back to 25%, which was the average, at 18 points on 66 trillion is roughly $10 trillion that's going to be looking for a new home. Of course, the math is imperfect, but you understand about my point here. Analysts are repeatedly suggesting that the new capital intensity of the hyperscalers are going to create a re-rating. The money doesn't vanish. It's got to rotate somewhere, right?
If the dollar loses even half its purchasing power over the next decade, retirement portfolios built entirely on paper assets face a brutal reset. This is where Rick Rule's thesis shifts from speculation into capital preservation, because hard assets remain one of the few sectors still ignored by institutional money flows. Wall Street keeps defending concentrated tech exposure, while quietly acknowledging hyperscaler capital costs are exploding underneath earnings narratives. The danger for ordinary investors is assuming liquidity trapped in overvalued sectors will rotate gently instead of stampeding suddenly. Next, Rick Rule exposes where trillions in exiting tech capital are most likely forced to migrate.
So there's really only one class that it appears on the other side of the trade that's big enough to handle this, and they've been starved of capital for 15 years, and that's hard assets. Is this rotation unavoidable?
It's predicated on your use of the word when with regards to the revaluation of tech, and I'm not prepared to offer up any opinion because I don't think my opinion has any value. I don't know what tech is worth, so I don't know if it revalues. That rotation is predicated on the word when.
I mean, their free cash flows. Their free cash flows are dropping.
I like the resource sector on an isolated basis. I don't care about it with regards to a valuation metric that I don't have any regard for my own opinion of. I look in a very absolute sense. The free cash flow that the gold industry enjoys right now, the need for the gold industry to reinvest in itself to maintain, never mind increase production, against the probability that gold revalues not against technology, but rather against the US dollar. Now, there, I do have some confidence in my ability to predict. I feel real good about that. I'm not discounting what you say, Gary. I just don't want to hold myself out to your audience to comment on this prospective rebalancing because I don't understand, and I don't pretend to understand, half of the equation.
All right. So back to this backdrop we're seeing today. I want to just compare it to 2022 for a moment. As the Fed was hiking rates back then, inflation was rising. It was outpacing rate hikes. Gold trended downward for the better part of 2022 until inflation started to begin coming down a little bit.
The largest technology firms are spending record amounts just to maintain growth rates that markets still treat as permanent. Rick Rule notes that he avoids pretending to know what tech valuations should be, yet he remains confident about one thing. Currency debasement mathematically benefits scarce hard assets over time. That distinction matters because institutional investors increasingly frame commodities as optional, while central banks continue accumulating real assets beneath the surface. For savers, the real risk is staying concentrated, where narratives depend entirely on confidence remaining elevated forever. Next, Rick Rule reveals why gold's relationship with real rates may be signaling another policy failure ahead.
And real interest rates started rising later in the year. Right now, we're seeing inflation rising, we're seeing gold falling, we're seeing real interest rates falling, and the prospects of Fed rate hike increasing. Are we setting up for a 2022 part 2 here, which would then set the stage maybe near the end of the year, beginning of 2027 for the next big rally in precious metals?
I have no idea. None whatsoever. I believe that real interest rates are sharply negative. I believe that what I would describe as inflation, which is the deterioration of the purchasing power of the US dollar, is running at between 8 and 10%, rather than what the CPI would have you believe. And if you juxtapose, to make the math simple, 10% deterioration in the purchasing power of the US dollar, the 10-year treasury isn't paying you 5, it's costing you 5. And it's that circumstance in the decade of the 1970s that propelled the gold price. It's important to note that concern about inflation, nominal concern about inflation, began in 1967 or 1968. The American investor didn't take note of that until 1972. At that period of time, the U.S. economy had come off what was described as the Camelot era, the period from the end of World War II, 1946, to 1967, 1968, with everything going very well, very, very, very well. The consequence of that is that investors' decisions were predicated on their experience in the past, which had been great. The parallels between then and now are staggering. The assumptions that we make about the future.
The Fed keeps insisting inflation is moderating, while negative real yields continue quietly destroying purchasing power underneath the surface. According to Rick Rule, a treasury yielding 5% during 10% currency debasement is not generating income at all. It is locking in guaranteed loss. Mainstream coverage focuses obsessively on nominal rates, because acknowledging persistent negative real returns would expose how fragile confidence in sovereign debt really is. Investors trusting official inflation metrics may not realize how aggressively their savings are already being diluted in real terms. Next, Rick Rule unravels why today's investor psychology dangerously mirrors the complacency before the 1970s inflation shock.
Are formed by our experience in the period 1982 to 2022, the most benign economic climate known to humankind. And so confidence, despite rising prices, despite the political response to rising shelter prices, rising food prices, rising energy prices, the investor response is predicated on the lessons learned in the period 1982 to 2022. I watched this happen before, albeit as a very young man. 1967 to 1972. When the assumptions change, response changes, and it changes very, very rapidly.
Markets still behave as if the stability of the last 40 years is permanent, even while housing, food, and energy costs signal a completely different regime emerging underneath. What Rick Rule is highlighting here is the psychological lag between deteriorating fundamentals and investor recognition, the exact delay that defined the late 1960s, before inflation psychology fully broke open. Institutions continue promoting diversification models, built for a disinflationary world even as central banks expand balance sheets into structurally inflationary conditions. By the time consensus finally adapts, precious metals repricing may already be well underway,